I first want to just kind of recap a little bit the income statement, but really in doing so, illustrate the difference between an income statement and a cash flow statement. And I want to go through an example of one like what we did this morning, on Monday, to kind of help really strengthen that and then get into valuation. So remember what we've done so far is I mentioned that there are 9 categories where you can kind of place expenses when identifying an income statement item. That's important for building a core model. That's important for putting together comps, right? So obviously you first want to identify revenue, and then we identify which of those expense line items go into cost of goods sold versus just other expenses, right? And that gives you gross profit, right? And really the main line item we're getting to, and we'll talk about after the break why, it has valuation reasons and some other reasons as well, is your revenue less your COGS less your CapEx is EBITDA, right? Earnings before interest, taxes, and depreciation and valuation. Depreciation and amortization. This is important for valuation. This is seen as a proxy for cash flow, and we'll look at why. Once you get to EBITDA, then you're slowly subtracting the components of EBITDA to get from EBITDA to E, earnings or net income. So D&A and what we face in Walmart is sometimes on an income statement they don't really identify or isolate depreciation and amortization. So that doesn't mean it doesn't exist in the income statement. It just means they haven't identified it on the income statement or separated it out. So we have to separate it out. We have to do some research, find out where D&A is, what it is, put it in our income statement. But when we put it in our income statement, we don't just stack on an additional expense. We have to realize this must come out of either COGS or OPEX, and so we separate out accordingly. That gets us to EBIT. Then we also want to note that there might be another section that may come below or above EBITDA. We talked about how and why. That's other income. Other income. So there might be some one-off line items that you see that's either equity and earnings from unconsolidated ventures. That could be other income. Or income from derivative instruments, or income from some sort of other income line item. And we have to put that in the other income section. But as analysts, we want to think about, well, does that other income come above EBITDA or below EBITDA? And it depends on a couple things, right? We talked about if you're comparing this with other companies that may not have that other income line, then we recommend to keep that other income line under EBIT, so that this EBITDA becomes comparable and equivalent to other companies. If we're maybe looking to buy this company, let's say in an acquisition scenario, and this other income is part of or a component of what we will be acquiring, then you might want to include other income in EBITDA, because that EBITDA is going to represent the value of what we're acquiring, and we'll talk about that in valuation. So once we get to EBIT, we'll subtract out interest expense, interest income. Right? So interest income we isolate versus other income. That gets us earnings before tax. Then we have tax, and then we have net income. Those are the major segments. Right? And then after net income, you might see some other line items that we would plug into either distributions or non-recurring events. And you have to think about what those line items are. Are they distributions or are they non-recurring events? If they're related to payouts to equity holders, they're distributions. Preferred dividends, common dividends, minority interest or non-controlling interest payments. Right? Those are distributions. Anything else that might be seen as extraordinary or one-time would be non-recurring. Right? So we used an example on Monday that was related to the test on Monday to illustrate how items would flow from the income statement to the cash flow statement. When you go from the income statement to the cash flow statement, what's the cash flow statement supposed to represent? Well, the income statement represents what our profit is based on the revenue generated and the expenses that are indirectly related to that revenue, right? Or directly or indirectly related to that cost of revenue. Now, the thing about the income statement is those line items may or may not actually be directly related to cash. In other words, there might be some revenue that you actually didn't collect, and there might be some expenses that you actually didn't pay. So that's where the cash flow statement came to be. So really kind of investors say, well, all right, you've generated $100,000 in net income, but how much of that is actually cash? And that's important. You might have 1,000 customers, but if they're not paying, you could have a collections issue, and that's not profit to me. And that's why for investors, we look at cash a lot, right, over net income. That's why there's a discounted cash flow, not discounted net income. Right? We believe that cash flow is more true to what your profits or what your earnings or what's coming out of the business. That's just another way of looking at it. On the other hand, in tax reporting, you're required to submit an income statement and a statement of balances. You're not required to submit a cash flow statement, not for tax reporting. For GAAP, yes, but not for tax reporting. So to the government, this is really what they want to see, how you generate your taxes, and then what you own, right? So the cash flow statement, the way we build the cash flow statement is we start with net income. We say, all right, well, this is how much you said you've generated on your income statement, but how do we transfer that into what's actually been produced in cash? How much is actually in your balance sheet? How much is actually in your bank account? And you do that by subtracting line items that are not related to cash. So for example, if your revenue, and let me just look at this a different way first. I'm going to erase, if you had this still written, don't erase it. I'm going to erase it because we have limited space on the board. If your revenue has not been received, what do you call that?
Accounts receivable.
Accounts receivable, right? Accounts receivable is the portion of revenue that's not yet been collected, right? If your cost of goods sold, we've talked about on Monday, is something that's not actually paid, right? This is expensed, this is utilized to reduce the revenue for tax purposes, but what does it actually impact? Inventory. It really impacts inventory. And we'll go through an example after this. Again, this goes back to the idea that you're not actually paying somebody each time you make a sale. But this is the effective cost of what you're producing, and that's able to be utilized to reduce your taxes. So you make an adjustment to inventory. OpEx, if you receive a bill, until you pay it, what does it become? What is it called?
Account payable.
Accounts or accrued expenses. There's a little bit of a difference. Actually, what is the difference? What's accounts payable? We talked about accounts payable. There's a little bit of a difference.
Your suppliers for
Accounts payable is related to COGS.
Accounts payable is related to COGS.
This is something you owe money for the product you receive?
It's something you owe money for the product to receive. And how is that different from accrued expenses? If this is an accounting question for banking purposes, you really don't
Because the
have
accrued
to.
expenses don't have something to do with you creating your product or generating revenue?
Which has what key difference? So in other words, from an accounting perspective, there is a difference of
Taxes?
not necessarily taxes, what you group into accrued expenses versus what you group into accounts payable. And so any bill that you receive that you haven't paid is generally accrued expenses. The one exception is, there's several other small exceptions, but the one major exception is the bill from the manufacturer, the accounts payable. The accounts payable almost acts as a reverse loan, or as a loan to the manufacturer. Why? What difference is that payment or expected payment to the manufacturer versus a bill that you've received that you didn't pay yet?
The inventory.
The inventory. What about the inventory?
That if it's account payable, I owe money, but
Yep.
I also have inventory.
Yeah, it's backed by an asset. It's backed by an asset called inventory. So accounts payable is usually, and you don't really have to know this, I don't think anyone's ever been asked this in investment banking. This is more of a Ernst & Young kind of question. But just so you know, accounts payable is usually, they both act almost the same way. It's something that you owe to somebody, and until you owe it, it's an account payable or an accrued expense. But an accounts payable is reserved for items that's backed against an asset, inventory. So it really makes it almost like a loan because it's collateralized in a way. You don't pay the manufacturer, they're going to take back the raw materials. Theoretically. That probably doesn't happen, but Accrued expenses maybe is based on a service, salaries, rent, things like that. Okay, D&A. We didn't talk about D&A quite yet, but when thinking about the cash flow statement, is D&A something that's payable or that's not?
It's not cash.
It's not. You never, just like COGS and inventory, D&A is something that you never pay. You don't write a check for D&A to anybody. This is kind of more of a theoretical accounting for the use of equipment. And we'll talk more about that. Interest expense. Is that cash or non-cash? Typically cash, so zero. So what I'm trying to draw here is, what are the potential adjustments to your income statement, right? If there's any potential revenue that hasn't been received yet, it becomes AR. COGS, you never pay, becomes inventory. OpEx, if you haven't paid it yet, becomes accrued expenses. D&A, you never pay, so that becomes an adjustment that you make to your cash flow statement. Interest expense, you always pay, so that's adjusted at zero. Taxes, could there be a portion of taxes that you didn't pay yet?
Yeah, deferred taxes.
Deferred taxes. Deferred tax. So if you think about this, and if you break down the income statement to the major possibilities of what could be non-cash, what could be payable, it's AR, inventory, accrued expenses. We'll look at this as working capital. We'll talk about working capital next week. D&A and deferred taxes. And this is basically how your cash flow from operations is derived. Your cash flow, so cash flow, begins with net income, and you make potential non-cash adjustments. You make adjustments to AR. You make adjustments to inventory, accrued expenses, D&A, and deferred taxes. And that's your cash from operations. It's the cash component of your net income. You start with net income and you remove all the items that maybe you didn't pay or receive in cash. That's where that comes from. And we'll talk more about that. So when we learn this stuff as we go forward, the point is, I don't want you to be memorizing the formula for the discounted cash flow. I don't want you to be memorizing. I want you to figure out and understand where this stuff comes from, because today a lot of these formulas are changing and it hasn't been documented yet. So it's important for you guys, especially if you're really doing it in practice, to be able to understand where this stuff is coming from, to create your own formulas and your own reasons for why these are what they are. So cash flow from operations is basically taking all the components from your income statement that are potentially payable. So let's isolate this and run through a few examples and then go into the other example. And obviously, this is what we're really going to hone in on next Monday and Tuesday. We're going to talk about this in a little bit more detail. I'm going to have you read some pages over the weekend that start, like the first 5 pages, talk a little bit about this. It steps through another one of the examples that we're going to go through today, so you have more practice, and then we'll model it out so you have tangible application to it. So let's say we have an expense, an accrued expense, on our income statement, cash flow statement, and balance sheet. And then we'll recap that. And our expense, let's say it's rent, has gone up by 30. Accrued expenses up by 30. What happens to income statement, cash statement, balance sheet if we have 40% taxes?
On the income statement, you have a tax savings of $12.
Yeah, so we first have our rent expense, that's SG&A, of 30. You tax affect that by 40%. Tax adjusted, right? The tax impact of 40%, 12. Right, that's the tax impact. Net income, 18. Now what?
Then you would add that back to net income on cash flow statements. It's not paid yet.
Net income 18, and then you say, all right, well, this is an expense that hasn't been paid yet. It's an accrued expense, so here, accrued expense, we add back 30. And so what does that become? That becomes cash of 12, representing the tax savings. Right? And then what? Now, the cash, we didn't learn about the balance sheet yet. We will next week or the week after. Cash, each cash statement line item should affect the balance sheet. Cash up by 12. We'll talk about how net income affects retained earnings, something you should have to memorize. 18, accrued expenses builds an accrued expense account, which is basically a liability of 30. That's how that works. So, I don't expect you to fully understand this, but hopefully as we learn more and more about the income statement, cash statement, balance sheet as they work together, you'll slowly understand more and more. Just slowly starting at the surface and digging deeper and deeper and deeper. So what do we have? So at the end of the situation, we have cash, we have an accrued expense account, which is a payable. We owe this to somebody. Then we have retained earnings. So what happens if I pay that? Now I've generated enough money, time has passed, I've paid my accrued expenses. So my accrued expenses goes down by 30. Now what happens?
No change in the income statement.
No change in the income statement, right? So difference, if an account gets created, goes up, that means you must have generated some income. If it's going down, if you're just paying it off, then you're just converting cash into a balance sheet line item. So accrued expenses goes down by 30. That's driven by cash, down by 30. And then on the balance sheet, cash affects cash, down by 30. And accrued expenses impacts the liability, down by 30. Paid. Cash gone, accrued expenses gone. That's the general idea. Any questions on that? Okay. Now, let's say, is this the example? Did I duplicate the example here?
You got a question?
No. Yes?
So in the income statement, even if you don't have revenue but you have expenses, you have to have an income statement, right? So if my company has expenses but didn't sell anything,
Yep.
it's going to be a negative.
It'll be negative. And that'll become a net operating loss. We'll talk about net operating losses soon. Next week, on the depreciation day. Okay, let's expand on this. And let's go back to the idea of, let's say where we are starting a business that sells, the example I came up with is energy drinks. I'm going to keep this on hold. And let's say that we are selling these energy drinks for $1 per bottle. That's our business model, $1 per energy bottle. And it costs us about 25 cents in manufacturing costs, the plastic, the sugar, whatever, flavoring, to manufacture the product. So the first thing we do, so the cost, $1 per bottle, cost 25 cents. The first thing we do, we're starting the business from scratch. We have no money. Haven't done that before. Too excited. Is we buy enough raw material for 100 units. We plan ahead. We know it's going to cost about 25 cents per unit. We buy enough material for 100 units. Take a second. What's the impact to the income statement, cash flow statement, and balance sheet? And note that we don't have cash yet, so our manufacturer is going to basically loan us the raw material. So we're going to build an accounts payable account to handle the funds of that raw material. What is the impact to the income statement, cash flow statement, and balance sheet? Right? So in other words, we're buying 100 units at 25 cents, the raw material for 100 units at 25 cents, and we're increasing the accounts payable account to fund that. Right? Take a second, tell me what the impact is.
The cash flow.
Cash?
You have inventory minus 25.
Yep. So first thing is we have an inventory line of minus 25. 25 cents times 100. So we're buying inventory. So this represents cash outflow of inventory. This totals into our cash flow statement, minus 25.
Well, shouldn't be account payable 25 and then 0?
Yes. So, yeah, you're right. So basically, just to illustrate it, you're right. So basically, the inventory side of it is your inventory. The first step, to me, it's easier to see this way, but maybe not. You could skip this step. But the first step is you buy inventory. So inventory minus 25 to illustrate that inventory has been accumulated on your balance sheet. Your inventory becomes plus 25 because you've built inventory. And that basically affects cash. But I said before, we don't have the cash for it. So our manufacturer is good enough to lend us that inventory. So what we do is we show an accounts payable account of 25, which would offset the cost of that inventory. So now our cash becomes 0. This represents basically the loan from our manufacturer. Our cash becomes 0. And then we have built an accounts payable account of 25. That's how that works. That's the idea. So inventory down, accounts payable up, offsets the need for cash. What happens on your balance sheet? You gain 25 units of inventory, and you now have this loan. 25 in loan, accounts payable. That's the idea. That's what you're left with. So I'm going to do, let me erase, where'd the eraser go? This to make room for final inventory. So I'm going to show the final balance sheet. Now the final balance sheet differs from the original balance sheet. This is just the movements based on the one example, but on the final balance sheet, we'll have cash of 0. It's going to look the same right now, but it'll change as we layer in more transactions. Our inventory is an asset of 25, and our accounts payable is a liability of 25. And the balance sheet holds. Assets minus liabilities is shareholders' equity. That's the idea. Okay, so we'll keep doing these, and you'll slowly get more comfortable with it. So now we've bought the inventory. No income statement impact, right? We've spent cash. We've borrowed basically money from the manufacturer. Standard procedure. Now let's say we've sold. So we have the inventory. We've converted it. We have now packaged bottles to sell. We've sold 20 of them in cash. We've now sold 20 units in cash. What happens to the income statement, cash flow statement, and balance sheet? We sell 20 units at $1 each. Walk me through what happens to the income statement, cash flow statement, and balance sheet. Take a couple minutes to think it through. So first, from an income statement perspective, what are we selling? 20 of them at $1 each. Revenue is 20. What costs are associated with that?
$5.
25 cents per unit. Right? So 25 cents per unit times 20 units. There's $5 in costs associated with that. Right? Which gives you an effective EBIT of 15. Right? 40% taxes, 6, right? And so net income is 9. Right? You okay with that? And then what you do is, you want to think about this marker's fading. I'll go downstairs so I can get more. But the net income starts the cash flow statement, and then you say, all right, well, which of these line items did not come in cash? I said that the revenue was made in cash, so you don't make any adjustments. Right? COGS is never cash. You don't pay COGS to anybody. Right? So hopefully this will. Why? Well, you actually owe the manufacturer, but he gave this accounts payable. He says, pay me later. So this COGS thing is a non-cash expense. This is something only utilized to reduce taxes. It's not something that's actually paid out. This is actually owed to the manufacturer, but you're paying him here. He gave you a loan. You're paying him later in one lump sum. So this you add back as inventory. This says, all right, well, I have this COGS. This was only used to reduce taxes because GAAP and the government allows me to do that. But I got to add that back because that didn't really affect my cash account. I didn't give $5 to anybody. I didn't. I'm gonna do that later. That's the idea. That's it. Those are the only adjustments. Taxes we paid, revenue we collected. This is the only adjustment. Did I do something wrong here?
No, good. Cash is 14.
Cash 14. Now what?
Cash drives the balance sheet.
Cash drives the balance sheet. 14. Inventory.
Down 5.
Down 5.
Retained earnings is 9.
Right? Inventory is down 5 because we've sold 5 units. So the inventory balance, which was 25, should go down by 5 to reflect the number of units we have left. And net income always affects retained earnings. Just have to memorize that by 9. And the cash of 14 offsets by the inventory of 9 balances because the retained earnings is 9. So when we apply these balance sheet adjustments to the final balance sheet says, well, we had 25 of inventory and we still owe our manufacturer 25. Now we've generated a little bit of cash, so our cash goes up from 0 to 14. Our inventory has gone down by 5 because we sold 5 units. So we'll only have 20 worth of units to sell. Remember, we sell them at a premium. And the retained, now we have, our accounts payable doesn't change until we've paid the manufacturer. Our retained earnings, though, this is a new account now, our retained earnings is 9. Retained earnings is basically the accumulation of net income over time. That's basically what that is. That's the idea. Now what happens if we sell 40 products? I'm going to make it a little more complicated. On credit. 40 products on credit. And I sell 40 on credit, meaning there's a new adjustment here, that revenue that we've recorded that does not get collected in cash. So we need to subtract that from our cash. 40 products on credit. What happens to the income statement, the cash flow statement, and the balance sheet? Yep, income statement.
We have revenue of 40.
Right, so revenue now is 40, since we've sold 40 at $1 each. It's easy. And there's costs.
COGS goes down by 10.
Goes down by 10, right? 25 cents times 40 is 10, giving you EBT of 30. And then we have 40% tax rate on that, which is 12. Gives you net income of 18. Right? Pretty straightforward there. And then that net income drives the cash flow, and now you want to go back and say, all right, well, what items in the cash flow statement did we actually not pay or collect in cash? Well, I said that the revenue was on credit, so we actually didn't collect this in cash. So we need to make an adjustment to AR, showing that even though our net income is 18, boosted from that revenue, if you look at our cash account, we got to subtract out 40 because that actually never came out in cash. Conversely, with our COGS, even though our net income was reduced by 10 in COGS, we actually never paid anybody that. So we need to add that back to properly represent cash. 10. This is actually cash. So we add this up, and we have 12. Net income negative 12, which is represented really by the taxes paid. This is the only cash impact right now, right? When you didn't really collect your revenue, and you didn't really pay these expenses, the only cash impact is taxes. So that should slowly start to make sense. Notice that each time we're doing this, there's a pattern there. So the way you should be processing this, if you're not familiar, start to just memorize the movements as you practice this, and over time you'll slowly start to get the concept behind it. At least that's the way I had done it. And so, sorry, this is cash, not net income. And so cash drives cash. So cash is down by 12. Then AR goes up by 40. Inventory is a reduction because inventory has been sold, it's gone away. Right? AR is created, the customer owes us. So this is going to sit on our asset balance sheet until we collect it. Net income always becomes retained earnings, 18. And this should balance the sum of our assets. Cash 12, that's 22, less 40 is 18, should equal our retained earnings. So how does this apply to our final balance sheet? We had 14 in cash, we just spent 12 on taxes. So now we have 2 in cash. We had 20 in inventory, we just sold 10 units. We now have 10 in inventory left. We have a new account, AR. Accounts receivable. New account, 40 that we've created. Accounts payable, we don't touch until we actually take the cash that we have, if we have enough, and pay them down. Retained earnings goes up by 18. This is 27. This should match. The sum of our assets, 52, less our liabilities, 25, is 27, is our shareholders' equity. That's the balance sheet formula. Balance sheet we'll talk about soon if you don't get it yet. Okay, now let's do another one. We have 40 units left, right? 40 times 25 cents is $10 in inventory. We have 40 units left to sell. Let's say we sell them 20 in cash, 20 on credit. So we'll take time to process this, jot this down, I won't erase it, but we have now 40 units, we're going to sell 20 in cash and 20 on credit. All right, well, what do you guys get? Let me erase this. What do you guys have? Income statement doesn't change, right? It's the same. We're selling 40 units. Whether it's on cash or on credit, you're still selling 40 units. You still have costs of 10, etc. The income statement doesn't change. The idea of cash versus credit, payables versus non-payables, that all comes through in the cash flow statement. So net income is 18. And in this case, well, the COGS and the inventory, whether it's sold in cash or on credit, no matter what, this is an add back, right? This is manufacturer inventory kind of thing. The difference here is in revenue. I said half was collected, half was on credit. So we do have an AR adjustment, but it's a smaller AR adjustment of 20. Down. Right? So similar to what we had before, where we adjust for inventory and net income, but instead of AR being negative 40, it's negative 20, because half has come in. So that leaves us with cash of 8. And we talk about how this impacts the balance sheet. Well, cash is 8. Inventory goes down by 10. AR is created, 20. Net income affects retained earnings, 18. Notice I'm switching the signs, and that might be confusing for you guys. Simple rule, with the exception of cash, if it's an asset, if any cash flow turns into an asset, the signs get reversed, right? Because you spend money to build an asset. That's the only rule, right? Think about buying an asset. If you buy an asset, money goes down, asset goes up, right? That's the same for every single asset. That's the only exception. Anything else, you don't switch the signs. If it goes into a liability or retained earnings or cash, signs don't change. But the only exception is an asset. You spend money to build an asset. That's the opposite of a liability, where if you're borrowing money, if you're taking out a loan, liability goes up and you get cash, right? So if you see positive cash, that's going to go into a positive liability, right? So when you're shifting things into the balance sheet, you usually don't reverse the signs. The only exception is an asset. If you're selling an asset, or you're selling inventory down, cash comes up. You receive cash for that inventory. So that's the general rule. We'll hone in on that really specifically. We'll drill into that when we talk about the balance sheet. So now let's apply this to the final balance sheet where we had cash of 2. We generated 8, so our cash is going to go up to 10. Our inventory now goes down by 10. That makes sense. We've sold everything. We have no inventory left. Our AR goes up by another 20. Goes up by 40 to 60. Right? We're owed a lot of money. AP doesn't get touched until we decide to pay back the liability. And then our retained earnings, our retained earnings goes up by another 18. So that's 45. Right? So retained earnings goes up by 18 to 45. Right, so now we have cash of 10, AR of 60, AP of 25, and retained earnings of 45. So now we're done. We've sold all our inventory, and we kind of owe our manufacturer now his money. Right? He was nice enough to give us a break and say, well, I'll give you the raw materials. When you start selling, when you start making a profit, you can pay us back. We owe him 25. Well, you know what? We don't have 25 in cash. Why? We have customers that haven't paid us yet. So let's do this. Let's say we collect on our receivables and we pay the payables. So what happens? How do we collect on our receivables and pay the payables? All right, this should be relatively simple. And there's no income statement impact here, right? Sales have been made. So to collect on our receivables, right, it's a positive cash inflow. AR is up by 60. That's how much we're owed. And let's pay our payables at the same time. So AP is a payment, down by 25. So we actually come out cash positive, right? 35. And so how this impacts the balance sheet is, well, cash is up by 35. AR is 60, so I told you about reversing the signs when it's an asset. We've collected, so this asset should go away. Not owed it anymore. AP is a liability, so we've paid that AP should go away. And that balances. And how does this impact the final balance sheet? Well, our cash goes up by 10 from 35, so by 30, sorry, it goes up from 10 by 35 to 45. AR goes down by 60 to 0. AP goes down by 25 to 0. So we're left with cash of, 45 and retained earnings of 45. And that should make sense, right? The idea is if you had 100 products and just did this all at once, this is a good sanity check. If you had 100 products and you know you're selling $1 per bottle and the cost is 25 cents, and let's say you sell them all at once. So you got $1 per bottle, sell it at 25 cents. That means you're making 75 cents per bottle, right? So you sell 75 cents times 100 times 1 minus the tax rate. That's 45. Right, if you were to sell it all at once and paid cash, you should have received 45 in cash and have 45 in retained earnings.